Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 5,018 to be exact. That is up about 6% year to date, down about 4% from the peak. Market having a little bit of a consolidation period after the sort of dramatic rise that we've seen since last October. That's not out of the ordinary for the market to consolidate a little bit after it's risen that far. All eyes on the Fed currently. Yesterday was Fed Day. They came out and basically released their minutes from their previous meeting, left interest rates stable, and then Jerome Powell had a press conference to talk about those minutes, let everybody sort of pepper him with questions. And we will kind of give you the bad, the medium, and the good associated with that press conference and press release. In the press release, the Fed basically addressing the elephant in the room by adding a statement into the press release that says, hey, in recent months, there has been a lack of progress towards the committee's 2% rate target, which is basically just the Fed coming out and acknowledging that, hey, in the second half of 2023, that inflation data seemed like it was progressing pretty sharply down to that 2% number. And then for the first couple of months of 2024, really appears like that progress has stalled, if not maybe gone sideways, maybe going actually in the other direction. The most recent monthly CPI numbers have annualized out to more like a 4 to 5% rate as opposed to that 2% rate. The Fed basically just coming out and saying, yep, we see what you guys are seeing too. And that basically means that we got to be cautious about what we're doing here. In the medium term, kind of good news, not really good news, not really bad news, Powell came out in the press conference and basically clarified that in his mind, that he viewed future rate hikes as unlikely, that the Fed would not need to sort of dust off the playbook, if you will, of raising interest rates, but that probably what this sort of stalled progress towards that 2% target meant in his mind was we're going to see rates hang out at this sort of 5.5% for quite some time. And indeed, if you look at the forward market, that's what the bond market is currently pricing is sort of, no interest rate cuts for the rest of the year and or maybe one at the very end, but certainly nothing in the very near term. In the good news camp, we have to talk about what the Fed talked about in terms of their balance sheet. To recap, the Fed's balance sheet is a tool that they use to stabilize markets and to potentially move around interest rates on the long end of the curve. Back in 2020, in March of 2020, the Fed went out and they bought a whole bunch of debt, basically to try and stabilize that market. Everybody during that, free fall COVID, nobody wanted to own anything other than cash. The Fed basically stepped in and said, hey, we're going to go out and buy a bunch of bonds so that people aren't worried. It will be a provider of liquidity into the marketplace. So they bought a bunch of bonds. Around about April of 2022, they said, hey, we've purchased all this debt. We've taken our balance sheet from about $4 trillion to about $9 trillion. And it's time for us to try and reverse that trend. So we're going to start to sell those bonds out into the marketplace, basically run off our balance sheet. And they've been doing that since about April of 2022. And yesterday, they announced that they would start to slow the pace of that runoff. So long story short, they used to be selling, several $65 billion worth of bonds a month into the marketplace. They basically said hey, we're going to reduce that sales process. We're going to kind of taper a little bit the rate at which we're selling. Now, the important thing about that is this. When I sell bonds into the marketplace, it has the effect of raising interest rates, right? More supply of paper out there means that investors demand more in terms of interest rates to purchase that paper. So the more that the Fed was selling into the marketplace, theoretically, the higher the interest rates are at the later end of the curve. By the Fed announcing that they're going to taper that process, it's kind of an indication that they feel comfortable enough that they're willing to let interest rates on the long end of the curve kind of fall a little bit. So lowering interest rates on the long end of the curve, which I think a lot of investors or the fixed income investors are looking at and saying like, okay, the Fed is acknowledging in the statement that progress towards, this 2% inflation target isn't great. But with the tapering action that they announced today, they're saying, I'm not so concerned about it that, we're not willing to at least lower interest rates at the long end of the curve. And we think we're still in a pretty good shot to get this thing under control longer term. So all of that is kind of the wah out of the Fed and kind of explains why we saw a little bit of a rally after the minutes and after Jerome Powell's Fed press release. The Fed taking a very sort of, I would say, middle of the road view towards the pace to controlling inflation. Would be remiss if we didn't mention earnings season. We are about 60% through earnings season at this point. Earnings coming in at about up 5.8% year over year. Revenue at about plus 4.4. That is ahead of the 3% consensus. But as we've talked about in previous earnings cycles, being ahead of consensus is actually in line with expectations because most companies normally beat. So, your sort of key takeaway for first quarter earnings season is that it's pretty much in line with what most people would expect. With that, as always, if you have any questions, please reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.